Yeah, I think it's a challenging environment at the moment for these VC-backed companies that have raised a lot of capital in the last few years at very high valuations and high multiples in terms of their revenue. And the IPO market has quietened down this year and last year. In 2021, we saw a record amount of IPO activity. In Europe, we saw over 300 IPOs exiting around about 150 billion euros. In 2022, that figure was around about 65 billion. In terms of exit activity, and then in 2023 we've seen only around about 3 billion in terms of exit activity. So it's definitely seen that decline so far in the last 3 years. Looking further back, the IPO value and volume has oscillated a bit more rather than deal value. We've definitely seen that IPO activity come down and the public market valuations enter the top end of the spectrum in terms of VC.
Can I ask you about the signaling function of some headline names? Stripe is one that everybody's been watching, and it was only just this month we saw the valuation halving, or nearly halving to 50 billion. If Stripe is having to nearly halve its valuation, what does that mean for those behind it that don't have the same name and same ability to come to market with what you think would be better pricing action?
I think that's definitely a valid consideration. I think it's obviously something that's taking place across the market. We're definitely seeing valuations come down across the market, not just in the US, but also in Europe. Klarna is an example where they received a valuation haircut that was relatively drastic for a European-based fintech company. And it's just a more challenging fundraising environment at the moment. I think valuations in 2021 were sky high. Borrowing costs are very, very cheap. Capital was abundantly available. Now we fast forward with rising interest rates and inflation. We're seeing funding conditions being a lot more difficult for these companies, and growth rates are slowing as well. And that's where we're seeing that slowdown in valuations and funding, and we may potentially see future haircuts later this year and even in 2024.
Extraordinary what you said to me there, asked about Klarna, because I'm pretty sure the CEO said to me early last year that I was completely wrong and that his valuation hadn't been sived on the back of what I'd seen at rivals. But anyway, we'll leave that point. Is the money available for backing these companies now? I mean, the fact is, VC has got a lot of asset on its books, as indeed as private equity, which, quite frankly, it can't flog. So I'm just wondering, we keep hearing about powder dry, loads of powder dry, but quite frankly, haven't they got to kind of get rid of some of the assets that are on the book that they need to reprice before they can start recharging and looking at new assets?
I think VC and PE generally are more of an illiquid asset class compared to public markets, where we see price volatility impact on
You mean
on
price
valuation.
realisation rather than lack of actual mark-to-market on the asset?
Exactly, and a lot of these firms may have been invested in the last few years. They may have secured financing in the last few years, so we may be just seeing the correction of that taking place in the market. There still remains a lot of dry powder in the market.
Right.
A lot of capital has been committed to these VC funds and PE funds within Europe, and it hasn't been deployed yet. So we have seen in our data a lot of dry powder still is out there, and it depends on kind of the markets and funding conditions of these assets going forward, whether they do deploy that capital and then obviously invest it into startups. I think timing is everything in the market as well, and investors who do have dry powder at the moment may look to deploy capital to take advantage of those depressed valuations and ultimately realise greater returns in the long run.
Interesting.